Two CPI numbers have set the markets ringing. The US CPI number came in lower than expected. India CPI number came almost in line with expectations. And we are seeing a huge rally in stocks, bonds and the currency, the Indian rupee as well. And then, of course, there are 2024 forecast reports out. Morgan Stanley's has come. And joining us to discuss the India report is Upasana Chachra, the Chief India Economist at Morgan Stanley. Morning, Upasana. Thank you very much. Upasana is joining us from the sidelines of their Asia Investor Conference in Singapore. Well, first up, the CPI number. In line, we actually had a poll of 4.8, so it's a little higher than expectation. What's your full year expectation on inflation? And do you see the Reserve Bank changing its, hawkish tone?
Yeah, so the CPI number for October did come in almost in line with expectations. It's continuing its moderating trend, remaining sub 5%. So at 4.9%, it was just a tad above what we were expecting. I think more importantly, the trend in CPI inflation shows that the headline inflation is getting impacted more by the sticky trend in food inflation. We've seen another round of increase in food inflation driven by pulses and vegetable prices. And if we strip that off, then actually the core inflation numbers have been showing better trend and have been moderating. So October core inflation was at nearly a 20-month low at 4.3%. So all in all, I think the CPI or the inflation trajectory is evolving in line with expectations. We would probably see some numbers firming up again, going above 5%. So for probably November numbers come above 5 to at around 5.5% is what we are tracking right now, given that onion price inflation still remains elevated. But for full year fiscal 24, we expect inflation to average around 5.4%. So with this inflation backdrop, headline inflation being a little bit more volatile, impacted by food inflation trends, we think that RBI will remain on pause in fiscal 24 and continue to sound cautious, given that there are still some uncertainties from the global front. Of course, those are receding as we speak probably, but I think in this environment where uncertainties still persist, it will probably be prudent for the RBI to maintain a cautious tone in our view.
Okay. That point is taken. Just want to alert viewers to a news coming in. This is big. Siemens AG to buy an 18% stake in Siemens India. Clearly the India story, and multinational parents want to take advantage of it, or so it seems. So, Upasana Chachra, I am going to ask you about the India story and the growth story. Just a word more on inflation. I mean, you're saying that you're in sync with what RBI also is forecasting for the full year, 5.4. But food is not all about onion inflation being the only worry. Pulses in October were 18.6% higher year on year. And pulses is not like spices. Spices is 22%, but a small weight. Pulses have a good weight. Cereals, again, 10.5% or 10.6% higher year on year. Fruit and eggs have become 9.3. Suddenly, areas of worry. Do you think food can be nastier than we are prepared for?
So you're right, food inflation worries persist. I think what we've seen in the last few data points, it's been a bit mixed. We are seeing vegetable prices, the shock that we saw from tomato prices, but at the same time, there are other segments of inflation which are persisting. Is the line on?
Yes, please go ahead. We can hear you.
Cereals or pulses so those inflation worries are persisting. We think that, food inflation concerns will persist probably for some more time, because monsoon, all in all, was just at par, and sowing was also just at par. Rather, pulses sowing has been lower than last year, and therefore there will be concerns on output. And going into the winter cropping season, I think that's something again that we'll need to track in terms of area cultivated for wheat. The early news obviously is not that encouraging for area sown for wheat, but I think it's still very early days. So I think overall food inflation is something that the risks around it remain live in our view, and we'll have to continue to watch and track it. But again, I would stress that I think the underlying trend from core inflation remains encouraging. So food inflation to that extent can cause some volatility, but it is likely to be temporary in our view.
Okay, and of course countered by core inflation, as you correctly point out. The growth story now. You're sounding very confident of that 6.5% in FY25 and FY24, and going on to, I think, 6.4 next year and again 6.5. Now, current year itself, rural growth is still a worry. The FMCG volumes of several companies, not all, is still like, low single digits, even for big companies like Hindustan Unilever, who want a good rural demand. MNREGA's demand is very high. The 93% of the full year budget has been exhausted in the first 6 months. Wouldn't you worry in the growth picture on that front?
So I think when we think about growth from a 12 to 24 month perspective, what we are thinking in our framework is that growth will be driven by the investment cycle picking up, and as that picks up, that will help improve the overall job growth and income growth trends in the country, and that helps the consumption bit as well. Of course, as we speak right now, and from the pandemic, the recovery in consumption has been a bit lopsided. We have seen rural demand lagging and the recovery in that segment being quite weaker than anticipated. So I think as we go further into the recovery and as we are seeing early signs of pickup in capex, I think that will help to create a more broad-based basis for consumption growth to improve as well, and the gap between urban and rural to also moderate. I think we have to keep in mind that rural economy has been impacted by a series of exogenous shocks, is how I would like to term it. We had the pandemic, which was a bigger disruption for the rural economy. Then we had the inflation problem last year, again a bigger disruption for the low-income segments or the rural economy, if you to characterize it like that. And thereafter we've just been sort of recovering, and then we had concerns from weather because the sowing season this year was not very easy, so to say, and we are entering winter cropping season again with a little bit of concerns around the same aspect. So even while sowing and output or incomes from this from the agri side may not take a big hit in our view, but it is still creating some form of concern on the rural demand. So I think unfortunately rural demand has not had a clean slate for a recovery cycle to unfold completely. But I think if the weather related disruptions are behind us, we will see rural demand pick up, even as it will gradually, and that will narrow the gap between urban and rural in our view.
Okay. Point taken. The most credible force in India, the RBI, is, kind of with you, in sync with your numbers, 6.5% for the current year, and I think 6.6% they've already forecast for first quarter next year. But Upasana, there's a little more than just, I'm only playing devil's advocate here, there's a little more than just the rural fear for growth. There is also this K-shaped recovery that people are talking about. Entry-level cars are not doing well, SUVs are doing well. Affordable housing not doing well, premium houses are doing well. Motorcycles for the longest time have not seen, especially the entry-level 100cc, have not seen demand. There is a fear that there is a broad-based, K-shaped recovery, and therefore capex may go this far, but not all the way because demand may be a constraint. That doesn't bother you?
No, I agree with the fears that I think as we say, we can characterize it as rural demand or K-shaped recovery, i.e. basically the low-income segments have lagged the recovery in this cycle versus the trend in demand that we are seeing from the upper income segments. But I think if we were to just take a step back and think if the virtuous cycle has to unfold, then as employment growth happens, that will help in creating a more broad-based consumption story. So I am not worried about the K-shaped recovery creating constraints for capex, because we think that what's happening is that the capex recovery to some extent is also being especially in this at this juncture getting supported by the public balance sheet or the public sector related infrastructure spending. So that is giving its own push to the capex story, and alongside the improvement in demand, if we look at capacity utilization rates, those are picking up, and that will help push another leg to the capex story, and that will kickstart the virtuous cycle. And as that happens, I think the worries around K-shaped recovery will also abate. I think we need a little bit more time for the healing of the low-income balance sheets to take place, and we will probably see that unfold as we get into fiscal 25 in our view.
Okay, actually, you're just driving away the skeptics. I was only trying to play devil's advocate over here, but that's a very strong Morgan Stanley report that you'll have a 6.5% growth in India this year and more or less 6.5% in the following 2 years as well. That is their forecast. Thank you very much, Upasana Chachra, for joining us from the sidelines of your investor conference. On that note, back to you, anchors. How's the stock reacting? This looks like big news.
It does, Latha. So I just want to quickly clarify for the